Hi, everyone, and welcome to our webinar on surviving the financial liquidity crisis in Latin America. My name is Lautaro Musiani, and I'm an analyst here at AMI. I will be your moderator today as we tackle the impact of the liquidity crunch in the region. So we have a really interesting conversation planned for today, starting with a short presentation by John Price, our Managing Director, followed by an interactive panel from our industry practice leaders. Like in all our webinars, we encourage you to ask questions. There will be a Q&A session towards the end. So please find that Q&A button at the bottom of your screen. And yeah, fire away. So next slide, please. Right, so before we begin, let me quickly show you a standard legal notice. Please be advised that all the content here today, reflects the opinion of our panelists, and any information you hear, should of course be taken in conjunction with many other sources and sound business practices whenever making any business decision. Next slide. Yeah, and just a very quick introduction of who we are. Most of you know us as America's Market Intelligence, the leading market intelligence agency for Latin America. We have conducted over 4,000 projects since our founding in the mid-90s, working across multiple industries in Latin America. So that's over 30 years in the region. Some of you might or might not be aware that AMI's payments practice recently spun off into its own brand, PCMI, providing payments market intelligence, not only for Latin America, but also for global markets, including APAC, Europe, North America, and others. Next slide. So yeah, our essential function here at AMI is to help our clients make crucial business decisions based on intelligence and research. We do that by focusing on three key pillars: the customer, the competitor, and the context. We study and analyze these areas, to help clients make a number of decisions, which you can see here listed on the right. Anywhere from deciding which market to enter next, deciding which partner to align with, defending your market share, and even improving customer satisfaction. Ultimately, we help clients get through the chaos that is frequently happening in Latin America, in the good and the bad times. Next slide. Yeah, so joining us today are John Price, our Managing Director, Lindsay Lear, Managing Director of PCMI, our payments arm, Arthur Deaking, Co-Director of the Energy Practice, and Diego Rodriguez, the leader of the Logistics Practice. My name is Lautaro, and I will be your moderator today. So next slide. Yeah, so in recent weeks, some of our clients have inquired about the liquidity crisis. I think that the key takeaway here is that, we need to understand that we have now entered a phase of shrinking money supply. The recent collapse of Silicon Valley Bank in the US and Credit Suisse, are clear evidence that the era of easy money is over. QE, quantitative easing, or, a nice way of saying printing money, along with low interest rates, are now being replaced by high interest rates and the removal of excess liquidity globally. So before I invite John Price to explain what impact this crunch will have on the region and what it means for your business, we want to do a quick poll to understand that. So Vale, if you can, publish the poll. Yeah, so please, take a look at the options and let us know what you think. You can select up to 3 responses. We've made it this way because people, can be affected by different aspects of the crunch, and, understanding how this affects us, is helpful for everyone, since, it's a very dynamic situation that will keep evolving. Okay, guys, thanks for your responses. We'll close out the responses in a few seconds and review the results. Right, Vale, can we see the results? Right, so as you can see here, it's quite evenly split out. It's investment plans being frozen. It looks like it's the major worry from everyone here watching this webinar. And then banks recalling loans and shorting lines of credit, essentially a liquidity crunch is the second big issue, along with companies lengthening their payment terms, from net 30 to net 60, for example. Yeah, right. This is really interesting. I'll quickly let John take over so he can give us an overview of the liquidity crunch in the region. John, over to you.
Thanks, Lautaro, and thanks everyone for responding to the poll. It was pretty dramatic that the leading answer was that companies were freezing their investment plans, roughly 70%. I want to take a step back and look at the origins of the fight against inflation and why central banks have responded as dramatically as they have, that has led to both the massive expansion of credit just a couple of years ago in the heights of COVID and the reining in process now that is causing the havoc that it is. First of all, it's worth noting that the last 30 years, so almost everyone on this call, their entire professional lives has been in a period of time when US inflation was rarely above 2%. And we've got so accustomed to low interest rates and low inflation that we consider that the norm. And certainly the people operating central banks today have every intention of returning us to 2% inflation, and their policy direction points to that. But in fact, there's a very strong argument to be made that we cannot easily get back to 2% inflation. And the reason is that roughly 30 years ago, when this, what some people call the Goldilocks globalization period began its course, three things happened that really changed the global environment. First of all, China and India shed off the sort of protections of their countries and their massive labor pools. Together, they have over half the world's labor. Were suddenly involved in global business. And as a result, labor prices over the last 30 years have been kept down by the competing forces of India and China. Also at this time, Russia joined the world economy through its perestroika program, which brought in record amounts of investment and technology from Western countries that really helped unleash its natural resource potential. Russia, of course, is home to not only petroleum and gas, but also metals and many agricultural products. And by really ratcheting up the production of those products in Russia, that was also a way to bring down prices. And thirdly, baby boomers roughly 30 years ago, on average, were about 35, 36 years of age. And they reached a phase in their lives where they were able to start saving money. And those savings made their way into the capital markets of the United States. And that increase in capital had a profound effect of bringing down the cost of capital. Well, now baby boomers are retiring. In fact, more than half have retired by now. And that means they're now drawing upon those savings. So they're depleting the world of capital. So you put those three together and you see why it's going to be difficult for inflation to continue its Goldilocks globalization trend. On the next slide, you'll see what the US Fed has done in its policymaking. As inflation reached close to 10% last year, the US Fed began a very dramatic rising of interest rates. And at this point in time, the interest rates are slightly higher than inflation. But inflation, according to the Fed, is not where it needs to be. It needs to go to 2%. But based upon what I just said and echoing what many analysts have said, that may be an impossible task. And so the question now is, will the zeal of central bank policy and its determination to return to 2% inflation essentially create such a liquidity crisis that we end up breaking the economy with lots of bankruptcies and unemployment, et cetera? That's a big unknown, and that's what's being debated heavily. It is almost assured that interest rates will remain close to 5%, at least through the end of this year, for the simple reason that inflation is going to be difficult to bring down. So on the next slide, we're going to take a look at how Latin American central banks reacted. And this is absolutely crucial. I don't think enough is written about it. I think to sort of bury the lead a little bit, the liquidity crunch today in Latin America would have been a crisis if Latin America was not blessed with the competency and independence and boldness of its leading central banks. And that's saying something, because we are in a political populist mood in Latin America. And so central banks, their policies are almost universally disliked by populist politicians, and they're at loggerheads with them. So the ability to stay the course is downright heroic by these central bankers. But central banks in Latin America moved almost a year ahead of the Americans in terms of raising rates. And as a result, on the next slide, you'll see money largely stayed inside Latin America rather than fleeing to the US and other sort of safe assets. In fact, the Brazilian real and the Mexican peso and the Peruvian sol outperformed most leading currencies last year vis-a-vis the dollar. The Chilean peso, which suffered from political risk and perception last year, has bounced back tremendously as well. The Colombian peso, on the other hand, still is lagging largely because of political risk. And that's a whole nother discussion about Petro's policies and his combativeness with the private sector in Colombia. But the majority of the economic might of Latin America is enjoying strong currencies thanks to central bank policies. On the next slide, we'll see what higher interest rates mean in terms of costs to borrowers in Latin America. So this is mostly made up of governments and large corporations who go to the debt markets and borrow money. And as you'll see, there's going to be a big increase in what they owe in terms of interest payments this year. It will increase by roughly $86 billion. So that's $86 billion that doesn't get invested. That's $86 billion that doesn't get spent. It's to pay arrears and interest. And so this has an impact. Now, the question is, what is the impact on investment and spending? And that's what we'll look at on the following slides. So first of all, it's really important to note that in spite of all the focus that we put on foreign direct investment in Latin America, the majority of the money that is invested in Latin America in fixed investment originates from Latin America. And that source of money is not going away. It will be more harbored by legacy companies in traditional industries, and a lot less money going into innovative and higher risk enterprises. And as you can see, venture capital, which is obviously very much tied to the SVB collapse, that has dropped by at least 50%. Some suggest even more this year versus last year, after growing tremendously over the last 10 years. And other private investment, private equity, that will continue to flow because private equity actually looks for down cycles to invest. But generally, we're going to see investment slowing down a bit, but not collapsing. Okay, on the next slide. When we look at consumer spending overall, we also see an uptick. And this is in part for two factors. Number one is that the currencies are holding well in Latin America, again, thanks largely to very hawkish central bank policy. And the other is that Latin American consumers are not nearly as indebted as American, European, Chinese, or Japanese consumers. They're much less likely to have a mortgage, much less likely to have a large credit card debt, a large car loan, et cetera. So the change in interest, although it will impact companies and it does impact governments, has a much lesser impact on consumers because they're not highly indebted. So we will continue to see increase in consumer spending this year, even measured in dollars. And on the next slide, what is telling is that for consumer spending that is reliant upon access to loans, you will see a slowdown. So this is the number of passenger car sales in these leading markets in Latin America. And as you can see, it's been slow since the advent of COVID, but it was starting to pick up, and it will slow down this year ever so slightly. And again, car loans are generally, car companies take them on to help push sales, but they are not willing to eat much of the increase in interest. So they have to pass that on to consumers, and that has a profound effect on the monthly cost of a new car. And so we're seeing a slowdown. So where lending is important to stimulating demand, we're going to see a slowdown. Okay.
Thank you, John, for that overview. So now it's time to start the panel discussion. Our practice leaders will discuss how the liquidity crunch will affect their industries. And yeah, we're going to start off by having them answer some broad questions. So if we go to the next slide. Our first question today is, how will the liquidity crunch impact investment in different sectors? So Lindsay, how do you think this will affect payments?
Thanks, Lautaro, for the question. Hi, everyone. Thanks for joining us today. I think John did a great job of just opening us up. And when we're talking about the payments industry, very much growth in the payments industries has been fueled by fintechs, which are essentially startups. And the decline, really the collapse of venture capital, has been devastating to the sector. But it hasn't only affected fintechs and startups. It's really affected large corporations, incumbents as well. So what we've started to observe, throughout the first quarter of 2023, overall, and I really love the poll results because they completely reflect what I've been seeing, a freeze on expansion or investment projects. So prior to this liquidity crunch, fintechs for the past 5 years have been investing heavily, flush with cash, have been investing heavily, throwing a lot of plans out there to see what sticks, planning investments and expansions into multiple markets, pivoting into new areas of the industry, doing a lot of experimentation. A lot of that has been cut. A lot of plans and investment plans have been canceled, and I've noticed fintechs really laser focusing on their core competency, especially the area in which they are profitable and really seeking monetization. So we've seen a major scaling back of fintech activity. But not only among fintechs, we've seen large incumbent players, almost everyone, in a wait and see pattern, in a moment of hesitation, trying to understand, will the US economy go into recession? What's happening at the global level, and how does this impact our budgets, and how does this impact our funding of projects in Latin America? This has been the story up until just recently. The first glimmer of good news that we heard just recently was Mercado Libre announcing that they will create 13,000 jobs, 13,000 new hires in Latin America. And that's encouraging, right? It's showing new investment. Of course, this is an incumbent, a deeply entrenched, one of the largest and one of the first fintech companies in the region. So we're probably going to start seeing big tech and really large and profitable fintechs being the protagonist in disruption going forward, as opposed to new startups that, as we've seen over the course of the past 5 years.
Thank you, Lynn. So Diego, now turning to logistics. Will the crunch also affect startups in the logistics space?
Thank you, Lautaro, and hi, everyone. Thank you for joining us this afternoon. Very happy to be here. So when I think about the logistics industry and the impact that the liquidity crunch is having today, 3 key topics come to my mind. First one, it's definitely venture capital has declined in Latin America, and according to different sources and multiple interviews that I had so far this year, the decline in venture capital in Latin America in the logistics industry could reach between 60 and 80% versus 2022, which is a massive drop considering that venture capital has increased at even triple digit rates in the past 5 years. So definitely there's less interest among venture capital investors, specifically because supply chain bottlenecks and the issues that we experienced in the logistics industry during the past 2 years in the pandemic, those bottlenecks have untangled, and now we're seeing pre-pandemic levels in terms of transit times, lead times, the delays that we were experiencing last year, even during the first half of the year, they're abating now. So that is creating a lot of less interest from venture capitalists in the region. And also when we think about IPOs, we have seen how companies are very reluctant to going into the stock market because of the uncertainty that we're seeing. So big companies like Rappi, probably they will delay their IPO until next year. And that creates a lot of uncertainty because when startups are unable to get their hands on new funding, either by venture capital or by the public market, they're start struggling with their growth plans because they have very aggressive growth plans, and they at some point the pressure is starting to feel about becoming profitable. And that's the key topic that we're seeing across Latin American startups in the logistics space, because the disruption that we were seeing in the past 5 years has been driven by the disruptors, not so much by the legacy players. And that's when the third point comes to my mind in terms of how legacy logistics players are also freezing expansion plans. And we're seeing companies at the global level like C.H. Robinson, FedEx, Amazon, focusing on cutting costs, on merging divisions, on cutting unprofitable business lines all over the world. And that's also impacting Latin America because innovation that is coming from the disruptors, but also coming from the legacy players, will start to slow down in the next 2 years based upon the situation that we're seeing in Latin America. So those are my three key takeaways in terms of the logistics impact and the trends that we're seeing in the region.
Thank you, Diego. So now, Arthur, we know that LATAM's energy sector doesn't depend as much on venture capital, but do you think that investment patterns will change? What do you think we will see?
Thank you, Lau. Happy to be here. Welcome, everyone. Following on what Diego and Lindsay said, I think the energy sector is a bit more shielded from the decline that we're seeing in the logistic and payment sectors. We've seen VC and PE, private equity flows to climate sector falling around 15% in Q1 globally. So in LATAM, that percentage is likely larger, but it's not the 60 to 80% we're seeing in logistics. And the reason behind that is that there's this ticking time bomb, let's call it, which is made up of climate change, right? Which is happening, as well as the net zero targets that almost all the big multinational companies have announced. So these things are inevitable. They're still happening, and it's forcing investors and the operators, the companies, to continue to invest in projects and technologies that reduce their emissions. It doesn't allow them. The reality of the situation is that there is no time to waste. So the investments are still flowing to the climate sector, even though at a little bit smaller pace. We saw recently in Brazil, a French company, clean power producer Voltalia, announcing almost $1 billion investment in distributed generation solar for projects through 2025. There's many other projects and announcements like that going on almost a weekly basis. But what we do see is that it's also becoming quite challenging to hit the mid double-digit IRRs that many developers and investors are looking for. And that's the result of the things we've been talking about, right? Higher cost of capital, inflationary costs of equipment, supply chain issues, increased competition for these projects. In Mexico, for example, we see IRRs for greenfield projects around 13 to 15%. It varies largely by location and size and offtake agreements, but that is much lower than what we've seen in the past. In Europe, those IRRs can be 11 to 12%. So there's not much of a difference between what we're seeing in LATAM and Europe. And that, of course, is forcing investors to look at the less risky jurisdictions and away from some of the more riskier LATAM countries. What's also interesting is that investors looking to achieve these higher digit IRRs are now looking at next generation technologies. So carbon capture, storage, hydrogen, sustainable aviation fuel. All of these technologies have very large growth estimates, but the reality is that they'll be successful only in small pockets within specific countries in Latin America. We'll talk about this later, but hydrogen in Southeast Chile, hydrogen in Northeast Brazil. That's what I'm getting at, is that projects are still getting done, but the higher cost of debt is squeezing out projects that are located in more risky jurisdictions and that are not as soundproof. I think that's the key takeaway.
Thanks for that, Arthur. We've got a really good question here from Analia in the audience that I think Lindsay might be able to tackle. So Lynn, the question is, where are fintechs anticipated to continue growing and expanding despite the squeeze? What is different about those areas of continued growth?
Great, thanks Analia for the question. And we've done some decent thinking about this because we get asked quite frequently these types of questions. And while we've had a lot of pessimism this first quarter of the year, there are a lot of things to look forward to. And make no mistake, digital payments is still a rapidly growing sector. Most segments of the industry are still growing 20 to 30% annually. So there is still massive opportunity as Latin America continues to digitize commerce. Okay, so a couple of areas that we've identified where there is still a lot of ripe opportunity for disruption and growth. Because of this liquidity crunch, and I loved what Diego said about IPO delays and interrupting a lot of fintech's growth patterns, we're going to start seeing banks having the opportunity to lead the way in continuing digital disruption and digital evolution of the region. They did a lot of work to catch up during the pandemic, and now the leaders are in some ways really well positioned to take a leading role in continuing to digitize commerce. So that means that fintechs, B2B fintechs that enable banks and that partner with financial institutions to offer them some of these capabilities where they may be lacking, face a really wonderful opportunity. So, cloud-based core processing, companies that provide front-end development to banks, building a digital wallet, building a P2P capability, building buy, hold, and sell crypto capabilities, for example. Platform-based banking, helping banks get to market faster and customize their offering faster and in a more agile way. Banking as a service, not only leading banks, but mid-tier credit unions, community banks, just tier 2 and 3 banks who haven't necessarily fully caught up. We're going to have a lot more demand in rapidly developing these digital capabilities. So banking as a service companies that enable that rapidly will also find some really interesting opportunities. Not only banks, but also retailers are aggressively, but also a little bit under the radar, moving rapidly into credit and payments in general. And so there's going to be increasing opportunity to fully enable retailers and other non-traditional players to offer financial services. So that's just one area of opportunity. Lending. Okay, so John began the conversation talking a lot about credit and how there's going to be a slowdown of credit in large ticket items. But we're still seeing improved currencies in Brazil and Mexico, big spenders in the region. And we're seeing that consumer spending has not yet been impacted. So that's a perfect recipe for credit on lower ticket items, especially outside of traditional credit offerings, and for SMBs. When we looked at the poll options, we saw a lot of, for example, extending payment terms. Small businesses are historically and continue to be desperate for improved cash flow. And something as simple as improving payment terms from suppliers and automating that and helping from a tech-driven standpoint, automate credit offers to SMBs is a hugely undertapped opportunity in the region. And then the third key area that I would speak to is just money movement infrastructure in general. We're seeing new payment rails becoming developed. And so creating interoperability among those payment rails is critical, especially cross-border payments, institutional crypto solutions that help ease some of the friction in money movement, and just all of the digital technology that's required to secure money movement, digital identity, biometrics, tokenization. All of those areas related to the infrastructure of money movement are still moving extremely rapidly. So quick summary on some of the areas of the industry that are still powerfully moving forward.
Thank you, Lynn. And thanks, everyone. There's quite a few questions here, and there's one for John. I think you might be able to handle. So, John, if in some sectors credit will be squeezed, how do I compete in this context? What should I watch out from my competitors?
Thanks, Lautaro. That's a great question. Well, first of all, there's, looking at two sides of your business. One is that whenever you have a disruptive event that changes the market dynamic, there's going to be change in priority for your customers, whether you're a B2B business or you're selling directly to consumers. And so the first thing you need to do is reach out to your customers through good survey work and really understand how this changes things for them. Back during COVID, we did a lot of work for different clients around how customers were changing their priorities, where they were now looking to buy products if they couldn't go to a store, and also which products spoke to them in this sort of moment of distress. Back in 2008, during the financial crisis, which hit hard in Latin America, there was big changes in terms of loyalty, and a lot of suppliers pulled out of markets, and a lot of local brands gained share as a result. So the first thing you got to do is talk to your customers, work with a firm like ours to survey them and understand how their priorities have changed. And the other, of course, is looking at your competitors. I remember back in 2010 in Mexico, in the midst of the financial crisis, when consumers were really tightening their belts, one of the leaders in the breakfast cereal market suddenly and dramatically dropped their prices by about 35%. And their biggest competitor approached us and wanted to know, how long can these guys sustain much lower prices in the market before it really starts to hurt their business? And so we essentially dissected the cost of their competitor, and we were able to give them a pretty accurate forecast as to how many more months they could sustain these price discounts. And that was crucial for them to make a decision of whether they follow their competitors into price cutting or they protect their own revenue and just wait it out and wait for that competitor to come back. So understanding your competition's ability to compete and make bold moves like that in an environment like this, understanding what they're thinking in terms of how they extend credit to their customers, and whether you emulate that behavior or whether you do something to contrast it, becomes all the more important in a moment like this. So those are two ideas that we've seen a lot used over the years in moments like this.
Thank you, John. So Diego, now turning again to logistics. You mentioned that legacy players will probably hold back on investments during the crunch, but we all know that online retail will probably keep growing in the region, crunch or no crunch. So this brings up a question from Fernanda. She's asking, will larger players be better positioned to recapture share from the new disruptive providers? And if so, what steps should they take to win more business?
Thank you, Fernanda, for the question. So when we think about the massive windfalls that legacy logistics companies have experienced during the past 2 years, we definitely see that their balance sheets are really strong now versus the past, and that's a tremendous advantage when we consider the massive opportunities that we are seeing today because of the venture capital crunch that I was discussing before. We believe that there are lots of opportunities to acquire at highly discounted prices some of the startups that are not focused on the automation or the reduction of human tasks, because we see a wide variety of different startups in the region, but those focus on automation and focus on reducing human tasks are basically the ones getting the most attention now. And that's because logistics companies are basically looking into improving efficiencies, looking into serve their customers through lower cost. And that definitely requires a lot of automation, a lot of improvements in the processes that they implement for either order fulfillment or for last mile delivery. So when you think about the massive opportunity that we will experience in the next 6 to 12 months because of the collapse of the Silicon Valley Bank, many of the mid-sized startups in Latin America probably have all their funds with SVB, and now who will step in to open bank accounts to these startups, how they will get their hands into new funding. So that's probably one of the pressing questions that startups are facing, and this is a massive opportunity for legacy logistics players to use their deep pockets and actually start shopping around and see what opportunities are available. Because even though that e-commerce retail has a slowdown in Colombia, in Chile, in Mexico, even in Brazil, we're still seeing growth rates over 15%, 20% in some cases. And companies already invested in improving their infrastructure and improving their logistics networks. And now it's time to see how those investments play out. But it is really important for companies looking into the future, not seeing this uncertainty as a challenge, but as an opportunity to get your hands on very, very interesting startups, very good technology that is required to take your business and to serve your customers to the next level.
Thanks for that, Diego. So Arthur, there's a question here from Rogelio about investment funds. So development banks provide a lot of funding and there are mandated quotas of lending for renewable energy companies. How will a liquidity crunch change the role of these funds in terms of investment into Latin America's energy sector?
Great. Thank you for the question, Rogelio. The reality is that these multilateral lenders have been around for a while and will continue to be around for much longer. With the reduction of private lending, their role is going to become even more important. So that's the IDB, the World Bank, CAF, all the development banks you can think of are becoming increasingly involved in funding and developing projects throughout the region. I think the reality is that there's a lack of consensus between developed economies such as the US, Europe, etc., and developing economies regarding the energy transition. So developed countries, they want to move more rapidly away from hydrocarbon assets, while LATAM and other emerging markets are not ready to do that. LATAM doesn't want to depend on foreign markets for their energy supply. So they want to develop their own infrastructure, their own generation sources to create this energy independence. One big thing that they're focused on is expanding the use of gas, since I believe it's 80 or to 90% of its population is not connected to the gas grid in LATAM and in different countries. So the massification of gas is something we're seeing in countries such as Peru, Colombia, Mexico to an extent. But it's something that will improve the quality of life of many individuals, lower the cost, and also improve access to electricity. I think one big question that many companies are asking, especially the legacy companies, is how long will these assets, the hydrocarbon assets, and everything that surrounds it, still be relevant in Latin America? We've helped different players. We helped an European provider of grid equipment, a company that sells transformers and circuit breakers, understand what the market size is for those equipments, which specific products are going to grow, what's driving that growth, to really allow them to create a business model and a strategy that capitalizes on the highest growth products. So I think my final takeaway is that, higher interest rates in these local economies and the refusal of Western banks, Western private banks to lend to hydrocarbon projects is going to continue to increase this divide between developed and developing economies. And that's something that has to be addressed because there's a large financing gap that is currently underserved.
Arthur, what you're saying, I can link what you're saying with logistics and a recent project that we conducted in Central America and Mexico. We were looking actually into locations in which a global logistics company was looking into expand its warehousing footprint, specifically for cold storage. And we were looking into how power shortages are impacting the decision-making process of companies deciding where to invest next, specifically when we think about the power demand that a cold storage facility, a massive cold storage facility has today. We're seeing gas as one of the main drivers to meet that demand. So I can see the link between energy and logistics very well in those type of projects that we help companies in Central America, in Mexico, in South America, look into opportunities and how customers, how companies are looking into adjust their patterns in this new reality in terms of energy, in terms of new consumer demands, in terms of sustainability. So that's really amazing what you're sharing, Arthur.
Thank you, guys. So really quickly, John, there's a question here from Juan. He's saying, in the USA, we've witnessed a collapse in investment sales because cap rates are lower than interest rates. So it makes no sense to acquire assets for the time being. Do you think that this will also happen in Latin America?
Well, again, if I go back to what I talked about, where the sources of investment monies in Latin America, a relatively small amount of it is private investment. In other words, pools of money that invest purely for return. That's much more common in Europe and in the United States. Most investment monies in Latin America are invested by strategic investors to help build or grow their business. So companies are being smarter and optimizing where they invest their money, but there's still plenty of growth opportunities, whether it's nearshoring in Mexico or whether it's e-commerce across the region. There's all kinds of still growth around disruptive businesses, whether it's payments, whether it's logistics, as well as, as Arthur said, in new energy. So most of the investment is not strictly in pursuit of a higher return. The money that's in pursuit of a higher return, yes, it's going to sit and invest in treasuries, Brazilian treasuries or Mexican treasuries, instead of going into projects. But most investment in Latin America is not of that type. So that's why we're seeing less of an impact on investment levels.
Thank you, John. So if we can move on to the next slide. And then before we move on to the next big question for the panel, we'd like to conduct another poll. So Vale, if you could launch that one. Answers to this one will remain within AMI. We will not be publishing the results. It's just to get an idea of where we could support you in the future as you weather the crunch. So there's quite a few options. Make sure you're able to scroll down so you can see all possible options. So, Lindsay, there's a question here that you might be able to answer very quickly before we jump on to the next question. Do you envision more JVs and mergers between startups in Latin America due to the lack of liquidity?
Yes, thanks for the question. Yes, absolutely. Actually, it's JVs and mergers and acquisitions is always very active in the startup space. Many startups are founded with the sole purpose of exiting, of getting acquired. And so to long story short, yes, we foresee there being actually a lot of cheap assets for sale, especially among companies that have had trouble monetizing, have a consumer facing product and have trouble monetizing, but have some kind of interesting asset, whether it's a really engaged user base or some kind of interesting intellectual property or tech, a tech stack that a bank or a retailer or a larger fintech might be interested in acquiring. So yes, we do anticipate that. And we've started to see signals that will take place. And actually, we've had clients come to us to help them identify acquisition targets, particularly if they have identified a weakness in their capability and then they need a particular skill set or capability or tech stack to achieve a certain goal. Clients sometimes have come to us to help to try to field options and even vet that potential deal. So absolutely. And it's actually even a service that we've had increased demand for in the last 6 months.
Quickly there, one comment in the logistics space that's critical. One recent example, Rappi's acquisition in Brazil of box delivery, that fits that criteria. So it's happening in the logistics space, and I envision next 6 months, we're going to have a lot of acquisitions in the logistics space because of discounted rates and massive investments probably are going to be done in the logistics industry.
And just adding, generally, I think this is an amazing opportunity for legacy companies. We do a lot of research around innovation and what it takes to be an innovative company. And the fact is that large companies find it challenging to build innovation within their firm that disrupts their traditional lines of business. Just think of Kodak, who invented digital cameras. They didn't want to push it because obviously it would help accelerate the ruination of their traditional business. So most of the innovation in almost all sectors in Latin America, and there's been record amounts of innovation in recent years because of venture capital and because of just low interest rates. A lot of these companies aren't going to survive the shakeout. And so this is an opportunity for legacy players, whether it's banks that haven't kept up with innovation, whether it's legacy logistics players, whether it's large, fully integrated energy companies that want to be smarter on green energy, whatever the field, this is an opportunity to sweep in and purchase at heavy discounts this technology and these people, these innovators that started up their own companies. And I think you're going to see a lot of movement there. At least there ought to be, because this is an opportunity for legacy companies that they shouldn't miss out on.
John, that's a great point. And I love your insight around, legacy companies don't want to do the disruption in-house because of fear of completely unraveling their business value proposition. But we've seen what you mentioned. Visa and MasterCard have both been very aggressive globally in acquiring companies that are outside of their core business, but are aligned with trends that they know will threaten their business going forward. So real-time payment companies, open finance companies, crypto, any potential competitive threat out there, they go out and acquire the companies that are doing a good job so that now it's inside their business and they can swallow it up and expand their business and not be threatened existentially by these trends that are at their core kind of fighting against their core value proposition, but instead reinventing themselves. So I've seen it less from banks, but very much from the card networks, from acquiring businesses. And I think that's a great insight of what we can expect to continue to occur.
So yeah, thank you guys. That brings us to the next big question. Who will the liquidity crunch help and why? So Diego, in logistics, you think that large companies will actually benefit from the crunch? Why is that?
Lautaro, I think I already touched upon this, and I just want to be very brief in two things. First one, large logistic companies definitely have a lot of opportunities today, specifically because when I think about the macroeconomic trends, definitely there's a lot of growth in international freight moving towards China. The recovery that everyone was predicting after China was exiting the COVID lockdowns, it's actually happening. So we're seeing a strong rebound in imports in China. So that's definitely benefiting traditional logistics players in the ocean and air freight space. So there's a lot of opportunities in that specific segment. Also, when we think about startups or companies that focus on automation, two big examples come to my mind and are very interesting companies that are having a massive success in the region. Nowports and Logility. These two companies are basically creating lots of automation solutions for customs processes, to automating transactions. So that's where we are seeing growth in the region outside of what we traditionally talk about, which is domestic e-commerce, domestic and last mile delivery. Definitely that continues to grow, but we're seeing how consumers are changing their patterns, are changing their behavior. So when companies start to feel the pain because of the economic deacceleration that we're seeing, I think it's a really safe practice not to cut all your marketing investment or your marketing budgets, but to actually dissect what customers are looking for and how their behaviors are shifting from one service to another, how retailers are adjusting their logistics network in order to better serve customers, and thinking about returns, domestic returns. It's probably the next frontier, how to save cost. So instead of just retreating, I think the massive opportunity that we're facing today is actually dissecting how companies can adjust their service offering to this new reality, because consumers are definitely changing the way that they buy goods and services, and how we can align those new expectations with what companies are offering. I think that's critical to make better decisions in Latin America this year.
Thank you, Diego. And Arthur, my understanding is that next gen climate tech will be big winners during the crunch, but only in certain markets in Latin America. Can you explain a bit more about this?
Yeah, absolutely. And I'll actually combine Anna's question that asked, what percentage of next gen technology companies are actually going to make it versus those that are acquired by legacy companies. And the reality is that it's only a small percentage of these next gen companies in a standalone basis, right, by themselves, that actually make it. It's very hard, it's very competitive. Usually it takes a lot of CapEx to develop these next gen technologies. So if you are a company focused on next gen technologies, you want to be solving reducing carbon emissions now, not 10 years down the road, not for 2030. You also need to have a strategic advantage. So an example is, let's say you want to develop a hydrogen project. The reality is that there's no local demand for hydrogen in most LATAM markets. So if you want to develop a hydrogen project, it has to be export focused. It has to be derivatives focused. So using hydrogen to produce other end products like green ammonia and green methanol. If you're just going to export hydrogen as a molecule itself, you're not going to make it. There's no feasible way of transporting it. The costs are too high. So it's really about finding these specific pockets within countries that are going to be successful. So for hydrogen, it includes Northeast Brazil or the southern Chile. There's also pockets of opportunity in storage in the Caribbean, Dominican Republic, Jamaica. And then there's one thing that I haven't touched upon a lot, which is SAF, which is sustainable aviation fuel, which is super interesting because it's the only real solution to decarbonize the aviation sector right now. Hydrogen planes are not a reality until at least 2035. Electric planes also, the batteries are too heavy, so it would not work for commercial flights. So SAF, sustainable aviation fuel, is the only real possibility to decarbonize a sector that accounts for 2.5% of the world's emissions. Latin America itself is not going to be a major producer of SAF, it's going to have a percentage, but its role more than the producer of these fuels is actually providing the feedstock. So used cooking oil, what's left over after you cook chicken or steak, can be used for sustainable aviation fuel. What else? Animal fats, all these different types of biomass. Latin America is full of these feedstocks and is very well positioned strategically in terms of location, but also in terms of scale to provide these feedstocks for production in the US and Europe. So it's really about finding specific niches within sectors and within countries that will be successful.
Great. So if we can move on to the next slide, please. As we get towards the end of the presentation. So which strategies or approaches should companies employ during the crunch? So John, you've got experience in this area. Can you talk us through, you know, the best and the worst practices you've seen over the years?
Well, one practice that I've seen actually more commonly employed by Latin American companies versus multinationals is using the power of the purse to make money as a bank as opposed to an operating company. What I mean by this is most multinationals, when in times of liquidity crunch, they will tell their vendors, you know what, we can no longer pay you in 30 days. We're now moving to net 90 days. And all that does is threaten the viability of their vendors and possibly disrupt their operations. A smarter move, a move that I've seen done by companies like Telmex in Mexico, is to tell vendors, you know what, we're moving to net 60, but we'll pay you tomorrow, net 1, if you give us a steep discount, where essentially they're charging somewhere between 2 to 3% per month, either in a discount to keep their vendors afloat, but extract significant profits in the process. The other side of that is with your customers, saying to your customers, look, you know, we require payment by a certain amount of time, but we'll extend credit, but that credit is going to cost you in dollars 2% a month. So I've seen Latin American companies make more money with the financial arms of their businesses using their cheap access to capital to expand their profits in times of liquidity crunch, even if they've had to lower their prices and therefore reduce their operating margins. And the other thing is,
John, let me quickly interrupt you there, because what you're saying perfectly fits what we're seeing in the logistics industry, especially in the trucking industry, because when you think about the main truck operators, they account for roughly 95% of all trucking companies in Latin America. And these guys, they live on a weekly basis. So if you're a large trucking company, if you're a large legacy logistics firm that requires a lot of different vendors to cover one region in Mexico, to cover a different region, for instance, in the south of Chile, and you need to rely upon main truck operators, extending these credit lines that John is mentioning could become your great opportunity to actually lower your rates, become more efficient, and actually create a new system around the financing of these new systems. So definitely in line what you're saying, John.
Yeah, and you know, we're still coming out of a supply limited sort of inflation. In other words, we can't afford to discard vendors the way we did in the past. And so holding on to those vendors, but extracting more out of them is the way to go. And the other is a lot of companies, especially those in the professional services ranks, but any company that sells to both areas of the economy that are growing, as well as areas of the economy or customer segments that are threatened right now. There's a great instinct by leaders to say, you know what, these are tough times. We're going to make our cuts equitable across the company, because that's how you're going to maintain unity. And that's the right thing to do. That's the decent thing to do. The problem with that is, yes, you need to make cuts in those areas of business, those lines of business that are not promising right now. But by making cuts in areas that are actually either strategic, like marketing, or where there's actually growth, you're just hurting yourself. And so the smart thing to do is to be very strategic with your cutting. Yes, go ahead and cut where there's projected areas of lower revenue, but double down on those areas that are either going to stay the course where you can gain market share, or they're actually going to grow in this particular environment. So be very strategic about your cutting, and you'll come out of this much better than you would by doing the politically correct thing and cutting everybody even.
John, and to that point, just moving into my comments a little bit, to do that, I think what you're saying is spot on. And just a couple of tidbits there. To do that, to be strategic, companies have to be less reactive and embrace longer term thinking. So often, I mean, it's the nature of the beast. Companies are often ruled by next quarter's earnings call and needing to produce specific results and wanting to avoid a certain outcome and wanting to avoid looking bad and wanting to save face and that's all understandable. But the most successful companies, okay, you have to manage your short-term goals, but you need to be thinking more long-term, thinking about where your industry is headed over the next decade and try to minimize as much as possible reactivity. So much of what we see are companies, especially in Latin America, kind of pendulum swinging from one extreme to the next, and staying the course over a long period of time takes strong leadership. It takes focus. It takes stomaching these highs and lows, and you have to appease, right, your shareholders. But just some food for thought there to kind of do exactly what John is suggesting.
Absolutely. I think the expression is don't drive your car looking in the rearview mirror, right?
Yeah, because you're gonna crash it for sure. If
That's right.
if you're always looking into your obstacles, you'll always crash. So when uncertain times hit the marketplace as we're going through right now, I think just to wrap up my comments here is definitely getting your hands into clearer information, into filling in the gaps that you may have, will definitely help you a lot to make those strategic decisions moving forward, because right now we're in a crucial time, and the opportunity that logistics companies and companies operating in Latin America have today, I don't think those will repeat in the next decade. So the next 12 months are critical for your strategic decisions, because that will impact the way that you grow, that will impact the way that you are able to integrate new technologies and to integrate new services lines, and also cutting into those areas where you're not seeing growth. This is the moment to do that. So I just want to echo those two remarks by John and Lindsay.
Thank you, Diego. And to wrap up, Arthur, what would you say that energy companies should focus on during the crunch, and what should they avoid?
Yeah, thanks, Lau. Hard to follow those comments. Thanks, guys. Yeah, I mean, I think people usually think of energy and think of the generation aspect of it, right? Oh, I have a solar panel or I have a gas plant. But the reality is that energy touches every single industry and every single person in Latin America. And there is a tremendous opportunity, like never before, to transform how you consume and how you generate electricity. So a lot of companies now are a little bit more hesitant to make the investment in energy generation sources that are more efficient, because it's higher cost. But the reality is that in the long term, this investment is going to be paid back in a few years. You're going to be in a better position in terms of your carbon emissions. Your shareholders will be happy, and your costs overall are going to be lower than if you hadn't invested in these technologies. So there is, this hesitation, but it is a very good opportunity to transform how your company consumes and generates electricity.
Thank you, Arthur, and thank you, guys. I think we covered a lot of ground so far, and hopefully, have provided some helpful insights for everyone watching. I know it's now close to the hour, so just a quick reminder that we are recording this session, and we will be uploading the recording if you need to watch it at a later time. So yeah, that brings me to the next slide, which is the Q&A portion of the webinar. So feel free to fire away with questions. And we've got one here for Lindsay from Rebecca. She's asking, will the crunch lead to easier regulation to help fintechs fulfill their missions?
That's a great question, Rebecca. Yeah, thank you for the question. I don't know. To be honest, central banks lately have been particularly in Brazil, have been doing a lot to empower the payments industry, but from an internal perspective. What do I mean by that? With the enablement of PIX, with the enablement of open finance, with the capping of interchange rates, they're doing a lot to remove the opportunity to make money in the payments industry, pushing payments towards becoming more of a public utility. So that makes it more challenging in a lot of ways for fintechs to operate because it limits their ability to earn revenue. So I think that's an unintended potential consequence. Those regulations in themselves do not limit or restrict fintechs, but it kind of can work towards limiting their ability to exist and survive. It also creates new opportunities, right? New goods and services and value-added product services to add on top of these public rails that are being created. That's more of a futuristic view, and companies really have to innovate to figure out how to enable that. In other markets, we are seeing new fintech laws being passed in Chile and in Ecuador. So it's a completely mixed bag. Every country is at a different stage. I don't really see the liquidity crunch having a direct impact on fintechs, except potentially in credit regulation. We're starting to see globally, this hasn't happened in Latin America yet, but we're starting to see globally regulators cracking down a little bit on buy now, pay later companies and the practices they're having, interest rates and transparency regulations. And we're seeing in the US, for example, buy now, pay laters kind of move out of certain states where regulation is coming into effect. So this could occur, but you really have to look at it at a country level. And I think the bigger risk is moving more towards these public payment rails that push payments more towards becoming a commodity and requiring fintechs to innovate in new ways. So I hope that answered your question.
Thank you, Lynn. So now a question from Gonzalo to Diego. So in terms of valuations in the logistics industry in LATAM, what are the main factors that are pushing valuations down? Are they liquidity problems, or is it a more fundamental problem?
Thank you, Gonzalo, for your question. So from my perspective, what we're seeing in Latin America is not so much a structural issue with startups and with disruptors, as opposed to what we see in the US, where there's definitely a structural problem in which the majority of companies that are experiencing very rapid growth rates, they're not profitable at all. In Latin America, we are seeing the logistics space these companies are in better position, and it's not so much about structural issues, but more about the uncertainty that we're seeing globally. It's more about the fear that disruptors and startups are having today to go public because of high interest rates and how investors are moving their money towards safe havens. And the stock market has experienced this great uncertainty among the valuations that we're seeing in medium-sized disruptors across Latin America. So definitely the region is in much better shape compared to other regions in the world. And companies that are actually approaching a break-even position are the ones that will definitely hit the stock market at the end of 2022 or beginning of 2023. So we see a different picture in the region versus what we see in the US or in Europe.
Okay, thank you, Diego, for that. So one question here for Arthur. So Arthur, if you expect to see compressed returns for energy investments due to the crunch, where in the value chain should energy investors come in? How long will it take for them to see a profitable exit?
Yeah, thanks for the question. I think greenfield makes the most sense in most locations in Latin America because you can generate the most value for your money and maximize your returns. But that's especially attractive in countries where permitting is quick and easy, which is it's rare to find these days. Some of them are in Central America, where projects can be ready to build in less than 2 years, and then sold to other investors at a premium. But greenfield should be avoided in countries that have slow and challenging permitting processes. So that includes Mexico, because of grid congestion and political interference. Colombia is another country. In those countries, going from greenfield to ready to build can take 5 to 6 years, which is double the amount of time you see in those smaller countries. So Mexico, Colombia, Brazil, and even Chile, where it's more mature and a little bit more congested in the grid, investors should focus on what we call yellow field projects, which have already some sort of development done to them. They're not completely from scratch and can be ready to build in 1 to 3 years instead of 5 to 6 years. So you can see that profit or that profitable exit in half the time. Brownfield or operational assets make little sense given the high cost of capital. You're better off just investing in treasuries or something along those lines. The only exception there is if you can find distressed assets that are looking urgently for a seller and looking for an exit in the country. So that's the main overview of that.
Thank you, Arthur. So, John, we've got one here on regarding political arrangements and currency. So somebody's asking, given the geopolitical rearrangement pushed by BRICS, especially regarding currency, and all the countries adhering to it, including the Belt Road, how do you see that affecting major Latin American economies? And are LATAM economies and businesses de-dollarizing their ops?
Well, first of all, there is no BRICS anymore. That was an invention 20 years ago, and there was enough unity between those countries, and there was enough reason to cooperate. Resource countries complementing the highly populated industrial or service economies of China and India, respectively. Today, the level of cooperation between India and China is still very low, and there's really no reason for China to share the spotlight or, share currency risk with countries like Russia or like Brazil. What you have is a China that has a plan and has been executing that plan in terms of its foreign direct investment over the last 30 years in places originally like Africa, but also the Belt and Road, which is closer to home, and now globally. So they're interested in Latin America. Their first level interest was in natural resources, where they invested heavily. Secondarily was infrastructure to help bring those natural resources back to China. But also China is a country that has an increasing number of brands that it wants to sell. And the most obvious markets for their products are middle income countries like Latin America. So they're looking to Latin America to sell their automobiles, their technology, their digital products, et cetera. And I think that China went quiet during COVID in terms of its international engagement, but we're coming back to a period of time where they are now acting upon the economic imperative of expanding their businesses offshore. And what nearshoring has shown us, and nearshoring, people point to bad political relations between the US and China as the driver. The real driver is rising labor costs in China, which are now 4 times the manufacturing costs per person in China versus Mexico. China is no longer a place where you can cheaply outsource manufacturing, and Chinese companies know that. And so Chinese companies are coming to Mexico and Central America to stay cost competitive and retain their access to the US market. And increasingly, as the Japanese have done over the years, Chinese manufacturer or Chinese branded companies will begin to set up manufacturing and sales operations around the world, just as the Japanese did. So Latin America is a natural business partner to China, and it may have had a hiccup during COVID, but we're back to normalcy in that front, and we'll see continued investment by Chinese in Latin America.
Thank you, John. And we've got another question that you might be able to tackle from Stephen. He's saying, with the recent changes in government in Chile, it was foreseen that a lot of investment, including home office investment, might shift to developing markets like the US. We indicated that much of the capital in Latin America has remained in the region. Does that also include Chile?
Yeah, so Chile's gone through a pretty tumultuous 3-year period, starting with the protests that led to the election of Boric and led to the initiative to radically change their constitution. The wholesale rejection of that constitutional change by Chilean voters and the subsequent pivoting by the Boric administration, generally speaking, to something more market friendly. And I think some pretty sound policy statements by Boric when it came to foreign policy and their lack of support for undemocratic leftist leaders in Latin America has helped to calm certainly foreign investors interested in Chile. Now, the Chilean money class, this is the first leftist government they've had since Allende. And so they were genuinely spooked. And certainly a lot of Chilean friends that I had were looking for ways to move their families out of Chile and their businesses out of Chile. I think that has subsided somewhat. I think some did act upon that, but I think that generally speaking, that panic button is no longer being pressed by the Chilean money class as it was just a year ago.
Thank you, John. We've got one here for Arthur from Matias. He's asking, with the higher cost of capital in the region, what is the expected internal rate of return for renewables in Latin America?
Yeah, thank you, Matias. It's a tough question to answer broadly because it really is country by country and then specific sector by sector within the energy broader category. I would say that mid double digits is the estimated IRRs that you see across the region as an average, while in the US and Europe, it's low double digits, so 10, 11. But that difference between mid to low double digits is not enough for a lot of investors to take that risk that LATAM countries have in comparison to US or European markets. So we are seeing some investors actually shifting priorities to the more developed markets, the more competitive markets, because of the smaller risk that those markets have.
Thank you. So Lynn, we've got 2 questions for you. One is, are buy now, pay later companies going to reduce borrowing? I know we're going to see lower transaction volumes in store.
Okay, great. I'll take the first one. Are buy now, pay later going to reduce borrowing? I wonder if they mean lending. I'll speak to just what we're seeing in buy now, pay later in general. There's a lot of question of the sustainability of buy now, pay later, given this macroeconomic context. But in fact, we're seeing buy now, pay later fintechs actually scale up and not scale back. And how are they doing this? The first thing to understand is that buy now, pay later companies in Latin America are tending to go after those who do not have a credit card, but who are credit worthy. And there are over 150 million debit card holders who don't have a credit card in Latin America. So that's a huge and very interesting market. People have never had access to credit before for purchases most often under $100. So how they're dealing with this is not by scaling back lending, but increasing late fees, increasing payment frequency, insisting on weekly payment or extending payment, quarterly payment, for example, instead of monthly, and extending credit terms out to even 3 years. We're typically used to seeing up to 24 months in Latin America, but it's getting extended out even further. Imagine for low ticket purchases. So what's interesting about this segment, both buy now, pay laters and big retailers are tapping into a customer base that's more on the low income side. They haven't had access to credit before. They're not as price sensitive. In the long term, they're more interested in, can I make my next payment installment, rather than thinking about the total amount that they're paying in the long term. So it's an interesting model, and by making some adjustments to the payment terms and late fees and things like that, they're able to continue successfully serving this new segment. Oh, and the other question, will the credit crunch lead to a decline in transaction volume in stores? That's an interesting question. I don't believe so. I don't think we've seen that. We've seen recently e-commerce, for example, the average ticket has declined, but we've seen increasing frequency of transactions. So in any type of crunch, you might see smaller ticket transactions with increased frequency because people are living more on a day-to-day impact basis. Their cash flow is impacted. Of course, that is mitigated by credit. And if you're able to get access to credit, you're able to increase your ticket size. So you've got those two conflicting forces. I'm not exactly sure what the net impact will be, but you do have those kind of two simultaneous forces.
And I'd like to add two comments or two trends that I'm seeing in the retail space related to logistics, Lindsay. First one, in Brazil, what we're seeing is retail spending based upon logistics companies doing last mile deliveries, that retail is holding up. Actually, what we're seeing is in Brazil, the retail industry growing this year 1.5-2%, very slow compared to what we were seeing in the past, but still it's growing. So what just to wrap up, what we're seeing is lower transactions, lower or smaller packages, because as you mentioned, consumers tend to retreat and spend less on large ticket items, but actually we are seeing a growth in the volumes of smaller packages deliveries in Brazil and in Mexico. So that's a positive trend in the retail industry. And definitely a second point to add here is that Latin American consumers are not so much hit on the credit card usage. They're mostly using cash as a method of payment as well. So considering the differences that we have between US consumers versus Latin American consumers rely heavily still on cash. And that's probably one of the things that it's influencing the growth of retail spending, despite of the liquidity crunch.
Thank you, Diego. And now we have a question from Salvador. Are you seeing adoption by businesses in LATAM of AI? If so, which industries are starting to do so? Lynn, do you want to take this one on?
Yes. Hi, Salvador. Thank you so much for the question. I'm glad you asked it because I'd actually been wanting to touch on this topic, hadn't quite found the spot. AI has been around for a while. Okay. It's not that new. We've had an explosion recently, making it extremely accessible to consumers and very user-friendly. But AI, one of my additional recommendations is what to do in this credit crunch is you must be thinking about deeply embracing the newest technologies available, because companies need to cut costs. Companies need to operate more efficiently. Companies need to find faster ways to scale and monetize. And AI and machine learning helps you do this at a very core level. Most industry, to the point, what industries is it being adopted in? We've seen it for a long time already in banking. We've seen it already for a long time being used by most industries. It's being embraced even more aggressively for fraud prevention, for predictive models and optimizing the consumer journey. We're starting to see it more with ChatGPT, more with marketing and copy in the creative area. And that's going to be increasingly important to personalize your marketing message and even your product offering. Of course, in understanding credit and making credit offers, really leveraging AI is going to be critical. And this is why big tech, Meta and Amazon, who are already good at this stuff, with the decline of fintechs, are going to have even more potential impact in payments and commerce moving ahead. So I love the question. It deserves its own webinar. So just a couple of tidbits there.
Yeah, quickly, what you just mentioned is super important in logistics, especially when we think about route planning, how to cut costs in the last mile delivery. Automation and artificial intelligence is critical for logistics companies and trucking firms in Latin America, because there's a lot of overspending on gas and maintenance that can definitely be reduced through artificial intelligence and predictive route planning. That's super important. And when we think about blockchain, that's actually the ultimate leverage that companies can consider when using blockchain and logistics. and how to trace and better provide information to customers, not only the end buyer, but my client, which could be a CPG, a textile firm, how to leverage blockchain and how to use automation and artificial intelligence. I think we are in just the beginning stages in Latin America, but there's a lot of tremendous and very interesting disruptors working on that in that specific industry. So that's very aligned with what we are seeing in logistics also, Lindsay.
Thank you, Lynn and Diego. One more question for Lindsay. Are buy now, pay later companies having trouble getting access to capital to lend more, and are they having trouble finding profitability?
Great, thank you for the clarification on the question. Yeah, I don't know that I know specific cases of buy now, pay laters having more difficult access to capital, but of course, in the liquidity crunch, this is happening for fintechs all over the payments industry, and especially if you're considered to be high risk. However, at the same time, these are some of the fastest to monetize because they are in a highly profitable market. So I don't know that I have a very specific answer for you, other beyond the fact that fintechs all over the industry are getting squeezed and having much more expensive access to credit and capital in general.
Thank you, Lynn. And to wrap it up, John, we've got a question from Monica. What can we expect regarding the impact in insurance?
Well, what we've seen before when there's a bit of a liquidity crunch is that companies are loath to sort of drop their insurance policies, but they will look for policy mixes for benefit packages that are less generous and therefore less costly in terms of their policy costs, the fee structures. On the other hand, we will see more and more demand for insurance policies that help against, they're there to lower the risk of or the costs of project cancellations. So whether it's in the construction space or development space, policies whereby the cancellation of projects is a real risk, and they want to protect themselves against that. We will see more projects canceled because of lack of financing, and that is going to raise the cost of those kinds of policies. Those are a couple of examples. I'm sure you could go through the different fields of insurance and analyze it one by one, but those are a couple that come to mind.
Thank you, John. That's all the questions answered now. So if any of our practice leaders want to add anything else before we go.
I just want to sort of put everything a little bit in perspective, because I think that, in the life of our company, 30 years, this is either the 6th or 7th sort of down cycle in Latin America. But I think it is different in the sense that we are not seeing the wholesale flight of capital out of Latin America. As the graphs I showed early on showed, actually money is staying in Latin America because of higher interest rates there. So it's yes, there is the credit crunch, which is really an American problem, is going to have an impact on emerging markets, including Latin America. But I think the impact will be a lot less than we've seen in previous down cycles, precisely because of the maturity of some of these economies, the most important market economies, and the independence and expertise of the central banks and the boldness with which they moved early. We also see that Latin America, the type of debt that it takes on, which is mostly strategic debt and not a lot of pure financial debt, is therefore a market that's less levered and less vulnerable to rising interest rates. A lot of the pure financial investors in Latin America are family wealth funds. So this is private banking money, but most of that money gets invested outside of Latin America. So again, given the structure of Latin America and the way it borrows money and how it invests, is far less vulnerable to rising interest rates than a U.S. economy that's with a lot of pure financial investors and a lot more leverage in all of its sectors of the economy. So I think that that's important for companies to recognize. We talked about the virtues of being strategic in how you cut your costs. And I think that also applies to how you globally prioritize your expansions and your cost cutting. And Latin America is a much less vulnerable place than it was in the past, and that it is versus other parts of the world today in this credit crunch.
All right. Thank you, John. Thank you, Lynn. Thank you, Arthur, and thank you, Diego. And thanks everyone that's joined. And that's all for today. And hopefully we'll see you next time.